So finally, let's move to the broader market and portfolio review, and indeed your outlook. We've just come through one of the most extraordinary first halves in history. How have you navigated the portfolio through the amount of volatility we've recently experienced?
Yeah, it has been certainly a very volatile time. So one of the key things is identifying what's important to markets and what's driving things and what's driving company earnings. So I've mentioned a few times the impact of coronavirus on lockdowns, and that's clearly the biggest driver. So you need to identify out of that what's temporary and what's likely to be permanent, what have markets already priced in for companies. So when we look at the whole lockdown experience, there's been some certainly very temporary things in nature, and that will include what we were talking about before in terms of some of the shifts in spending patterns. So we need to be very wary of over-capitalising, say for instance, the very buoyant profits being earned by the retailers, being too pessimistic on companies exposed to global travel or tourism or leisure and the like. So we see opportunities for that to turn around, and we are reasonably positive that there'll be either some sort of virus vaccine candidate coming through next year or a degree of adaptation of society. I don't think we're going to be in lockdowns. I'm sure everyone in Victoria is glad to hear that on a semi-permanent basis. Human beings are great at adapting. They'll either adapt through developing a vaccine or adapt through learning to live with it and getting on with things. So life will return to normal, I think, progressively through next year. So as an investor, we want to look at those opportunities. So we see opportunities in some of the reopening trade, companies like, say, Qantas. Domestic travel starts to open up reasonably shortly, eventually international travel. That market structure's improved a lot, virtual duopoly, strong business, things like Star Casino, people are very resilient in terms of their spending patterns through there. Stocks been marked down a long way, and not get caught in too much to buying momentum in some of the online retailers like JB Hi-Fi and Harvey Norman. We've done well out of them on the long side. They're not really quite shorts, but just don't get caught into those. But there are other things in the market going on that are potentially more permanent. So things like the revelation of working from home. People still want to go back into offices, but what does that mean? Do people go back into offices 5 days a week? Quite possibly not. So what are the implications there for demand for office space and rentals? Foot traffic through CBDs and exposure there, both in terms of retail and transport infrastructure. There are potentially some long-lasting changes to come out of this. So we're quite cautious on some of those office REITs and transport-related companies as well. They could quite likely be permanent. Another area that's potentially quite long-lasting is through this, there has been a lot of economic disruption and a huge amount of forbearance going on within the banking sector. So, for instance, a lot of those office REITs and retail REITs and households are just not paying rent, and that has flowed through and put pressure on people who are just not paying their interest or normal repayments on commercial office or home investment property. And the banks have basically been given the green light by APRA to pretend that's not happening. So there's a whole bunch of potential bad debt built up in the banking system. We don't know how that's going to pan out, but what we do know is we're probably in for a period of very low interest rates for a long period of time. So we need to consider the implications of that. And those low interest rates, flat yield curves, the RBA is focused on yield curve control. It's not great for bank net interest margins. A lot of competition coming in there for low risk loans from the non-bank sector. So we see the banking sector having two risks. One, what does their credit book look like? Their capital's been a bit pressured. We don't really know the situation there, but also just long-term net interest margins, return on capital for the banks is under pressure. So structurally, we want to look for other opportunities. The flip side of that, very low interest rates means that companies that can deliver stable growth going forward are probably going to do very well. So we want some exposure to strong underlying earnings growth, be it in healthcare like a ResMed, or in the tech space like an Appen, something like that can give a solid long-term earnings growth. So a lot of opportunities on the long and short side, but identifying how the world is going to change and what companies are going to benefit from that or be impacted is key. How we've positioned the portfolio.
Thanks, Sean. So we've certainly seen in the last 9 months significant drawdown and obviously a rebound from there. Can you give us a bit of insight of how the absolute return strategy has done?
Yeah, so the whole point of the absolute return fund is to not take exposure to the market. So it takes long and short positions, but they're balanced out. So it's got zero market exposure, hence it's got a cash benchmark. So over the last 9 months since the coronavirus, or the fund's been running for a little over a year now, performance has been very strong. So after fee performance is in the teens, so greater than 10%, and that's been quite consistent both through the collapse in markets in March and then the rebound coming out of there. And the reason we've been able to do that is through that focus on risk control, portfolio construction, but being on top of the investment dynamics that are occurring through there. So the whole point of an absolute return fund is to be uncorrelated to those risk assets like equities and bonds and credit that can swing around and be a lot more volatile. So it's an alternative to cash. It gives better returns than cash, because cash is pretty much zero at the moment everywhere. So that's the whole structure of the fund, through stock selection, being able to generate returns for investors that are independent from the equity market and the big swings and the volatility that goes through there.